Fundstrat manager Tom Lee just went on to CNBC and stated where he believes are a few opportunities in the current market. Now, he did this in the midst of a huge market sell-off. In fact, the S&P 500 is down pretty significantly year to date, just a few months into the year, already down 10%. And keep in mind, on March 31st, JP Morgan stated they believe the risk of recession is now at 40%, and then just a few days later, just 5 days later, JP Morgan bumped it up to 60%. Now, what's interesting about all this is if we look at the heat map of the S&P 500 over the last week, it's very green. In fact, the S&P 500 jumped up almost 10% in the last 5 days. But this can actually be quite deceiving. If we look at what the top gaining days are from the Dow in history, it's all during a huge bear market. We have 2025, 2020, 2022, 2008. The best gaining days in the market all come during bear markets. And if we look at earnings revisions for the S&P 500 since November, we can see revisions are actually down 2%, with some sectors getting hit very hard like materials, real estate, and energy. So I want to go ahead and play this clip from Tom Lee, look at where he sees the opportunities, and we'll analyze a few picks and see if we agree.
Let's take us to our talk of the tape. Where do we go from here with all this volatility? Where are we going? Let's ask Tom Lee. He is Fundstrat's managing partner, head of research, also a CNBC contributor with me here at Post 9. Thank you for being here. So, Liberation Day didn't go as you thought. You apologized publicly for that, which I think a lot of people appreciated. You're always a stand-up person about that. What now? Where are we going?
Well, I think a couple of things that we're thinking about is we know markets have gotten very pessimistic. They've priced in a 60% probability of a recession. And if tariff negotiations de-escalate, then the probability isn't that high. So I think that there's still a big window for markets to have a large rebound, but it's really the path of this de-escalation.
Are we in a bear market? I mean, we're in a bear market, right? I mean, it almost doesn't matter, textbook, whether you say we are or not. It's like so many stocks got just absolutely destroyed before this uncertainty happened in the market.
Yes. I mean, if we define a bear market as stocks feel like a grind or you're losing money, I'd say it really started in December because markets were churning even through the February high. But if I was to define a bear market as unleashing a type of financial tightening that leads to a recession, we're not at that criteria yet. But I think it feels like a bear market for the average person.
I hear views of, well, it's really hard to get uber bearish now, because a headline at any moment, as I said in the open here, the market is waiting so hard for some bit of good news that if you're on the wrong side of that, you get a day like you had on Wednesday.
Yes. I mean, if I was to oversimplify the framing of this, U.S. and China have absurd levels of reciprocal tariffs at the moment. And if you believe those are in place, then the global economy is in trouble and you should be bearish. But if this is a matter of who makes the overture first or blinks, but we know it de-escalates, then I think the downside has it comes off dramatically, and I think stocks can actually do really well into the rest of the year.
So you'd be a buyer right now?
Yes, and with the apology that, of course, I didn't think Liberation Day was going to be this draconian, but yes, I would be buying stocks today. What
would you buy?
Well, one of the things we did for our clients last night is to look at what's called, Walter Deemer calls sold out stocks, which is worse than oversold. Sold out stocks don't go down because there's a lot of bad news priced in. Mm-hmm. There's a lot of stocks that didn't make new lows on Tuesday, April 8th. They made their lows a month ago, and they had lower volume on April 8th. Those are what I'd call washed out stocks. A group that I think is washed out is the Mag 7. So I'd look at Mag 7 as a place to really expect a rebound, including stocks like Tesla.
So Tom Lee acknowledges 3 key points. Number 1, yes, he points out the big banks have been increasing the odds of recession, with JP Morgan, as of April 5th, now stating they see a 60% chance of a recession this year. But really, this is dependent on one thing. Are tariffs here to stay, or are they just a negotiating tactic? Tom Lee seems to believe they aren't going to be here for the long term, and because of that, he wants to buy stocks that he considers currently washed out and he states he believes that the Mag 7 stocks are exactly that. Now, when we look at the forward PE of the Mag 7 stocks, we can see Google coming in at 17.29 and Meta sitting at 21.74. These are both stocks I've been paying close attention to over the past few months. So let's talk about Google for a moment. Google's a stock that over the last year is trading slightly down. If we look at them year to date, it's been a pretty significant sell-off, down about 16.3%. And just the other day, we actually saw them get a price target cut from Citibank, but at the same time, they still have a buy rating. Their stock's price target just went from 229 down to about 195. So why did they cut their price target? Well, they stated that they lowered the price target because of more limited visibility across the broader online advertising landscape, due in part to tariffs. Now, this is an interesting point to make because when we think about stocks that are directly impacted by tariffs, we don't really think about Google stock. And at the same time, we don't really think about Meta stock either. But here's what we have to understand. Advertising revenue is the largest business segment for both Meta and Google. For Google, it's around 76%, and Meta, it's around 97 or 98%. So this means when we enter recessionary periods, across the world, we see advertising revenue go down. We see these other businesses cutting on costs like advertising. And because of that, earnings and revenue from Google and from Meta go down. For example, if we jump over to my stock screener, let's come up here and plug in Meta. Like always, all this data will automatically load in, so if you want to get access to any of my spreadsheets and the ticker data add-on that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. But again, going back to 2022, we had a technical recession in 2022, and look at what happened to Meta's earnings per share. It was gradually increasing. In 2021, it got up to $13.99, and then when we entered a technical recession in 2022, advertising revenue dropped all across the world, and Meta reported earnings per share of $8.63. That is radically lower than it was in 2021. But look at what's happened in the last couple of years in the middle of a bull market. It went from $8.63 to $15.19 in 2024, all the way up to $24.61. Let's look at what happened to Google. Again, we can see nearly exactly the same trend. 2021 earnings per share up to $5.69. Then it declined in 2022 to $4.59, but in the past couple of years, it's climbed higher and higher all the way up to $8.04. So yes, these aren't stocks that are typically directly impacted by tariffs, but if tariffs do cause us to enter a recessionary period, these are stocks that are certainly going to be affected by lower advertising revenue. And I think that's what Tom Lee's pointing to when he states that if you believe the tariffs are here to stay, but if these tariffs are only here for the short term, this could be a huge opportunity. And to be honest, I completely agree with him. From a short-term perspective, Google actually has a lot of positive news right now, even though sentiment around the stock is actually quite low. For example, in their other bets revenue segment, they have Waymo, and Waymo is off to a strong start in Austin and gaining traction in other markets. They're quickly taking market share from other companies like Lyft. Waymo could very well be its own business in the future or a spinoff from Google. But the huge concern a lot of people have with Google is AI. Are they losing their moat due to AI? But a lot of people don't realize just how strong of a player Google is in the AI race. If we look at the LLM leaderboard, what can we see? Best in reasoning, Google currently comes in at number 2. If we look at best in coding, Google again comes in at number 2. Best in high school math, Google at number 2. And if we just look at best overall, we can see Google actually has a pretty significant lead over these other AI models. Let me be clear, Google is an AI leader, and I don't think people seem to realize that yet. Now, when we think about a potential recession, what's the huge risk for most businesses? It's a weak balance sheet. A lot of companies are able to make it through a recession, potentially even stronger if they have a strong balance sheet. So what does it look like for Google? What does it look like for Meta? Well, if we jump over to our balance sheet breakdown, let's take a look at Google. What do you notice about this company? Their total assets is coming in at $450 billion and total debt just $25 billion. So the debt to assets ratio is 0.06, extremely low. The current ratio is more than healthy with total current assets at $163.7 billion, total liabilities at $89 billion. And interest coverage ratio, how easily can they make their interest payments? And just off a quick glance, you can tell it's not a big deal for this company. What about Meta? We can see the exact same thing. Debt to assets ratio extremely low. The current ratio very healthy. In fact, total current assets is almost 3 times higher than total current liabilities. In fact, both of these companies have such strong cash positions now that they both decided to start paying out dividends last year. And because they're growing earnings and free cash flow at such a high rate and the balance sheet is so healthy, they could definitely grow that dividend at a high rate if they choose to do so in the future. So what does the valuation look like for these companies? Well, let's look at 2 different scenarios, 2 different valuations. We'll use a reverse DCF model and then a sensitivity analysis. Now, to start off with a reverse DCF model, it's going to tell us how much free cash flow growth is the market pricing into each of these stocks. So for example, with 0% free cash flow growth priced in over the next decade, Google would be worth about $81.21, but the current share price is $159.40. So the market is telling us it's pricing in growth, but how much exactly? If we bump it up to 5%, we can see 115. If we bump it up to 10, we actually get above the current share price. So immediately we know the market is pricing in less than 10% free cash flow growth. If we bump it down to about 9.7%, we get very close to the current share price for this company. With that in mind, we have to ask ourselves, do we think this number will be higher? Because if so, it's definitely undervalued. If it'll be lower, then the stock is overvalued. But if we jump over to Seeking Alpha, let's look at those earnings estimates. Even though Google has had their earnings revised to be quite a bit lower by many analysts over the past few weeks, we can still see earnings growth projections are ranging from around 12 on the low end up to around 14 on the high end. Keep that in mind. So according to the reverse TCF, it looks like Google would be undervalued. Let's go ahead and take a look at Meta. Again, thanks to ticker data, all this data will load in. If we go ahead and bump this one up to 10%, again, we get a reverse TCF price per share that's above the current price. If we bump it down to 9, we can see we get very close to the current price. So the market is currently pricing in about 9% free cash flow growth for Meta over the next decade. So again, Meta is another stock that, like most of the Mag 7, has had many bearish revisions over the past few weeks. But despite this, if we look at earnings estimates, we can still see earnings growth projections over the long term are still well above 9%, even if it's projected to be a little bit on the lower end over the next year. So again, according to the reverse TCF model, Meta would look undervalued. But using a sensitivity analysis, we can actually see what type of returns we can get based on the projected EPS growth and our projected PE ratio. So let's go ahead and take a quick look at Google. Now what we can see for Google, after we go ahead and remove our outlier in 2017, is our average PE ratio over the last decade is about 25.8. For the trailing 12 months, it's about 19. So simply by reverting back to its average PE over the last decade, you'd get about a 26% return. But what would your returns look like through 2030? Well, let's assume the low end of analyst estimates and go with a 12.5% earnings growth rate through 2030. We can see what their earnings would look like here. But what about the PE ratio? Well, let's assume the PE ratio never climbs back to as high as it was on average over the last 10 years and sits comfortably at about 21.5, still on the lower end. Well, what we can see is through 2030, our total return would be 120% with a compounded annual return of above 14%. So really solid returns based on fairly conservative projections from Google stock right now. This is something we obviously like to see. Let's go ahead and do the same thing for Meta stock. What type of returns can we expect? Well, for Meta, we can see the average PE ratio over the last decade is about 30.73. For the trailing 12 months, it's all the way down to 22. So again, simply by reverting back to that average PE ratio, you'd get a 28% return. So again, let's go with the low end for the earnings projections for Meta. Let's say it's just about 9%, which is close to what the market is pricing into the stock right now. Let's assume the PE ratio doesn't even climb back to its average again. We'll say it gets a little bit in the middle, maybe around 25.5. I'll hit enter, and again, you can see by 2030, your total return is 93.6%, and your compounded annual return is 11.64%. Now, what's interesting about this is I didn't even look at the best case scenario for both Meta and Google. I certainly think both of these projections could be higher over the next 4 or 5 years. But again, it goes back to what Tom Lee stated. Are the tariffs here to stay? That's the key question. For example, look at how tariffs are currently impacting Apple. A US-built iPhone could cost 90% more, Bank of America says. If Apple's not giving a tariff exemption, analysts are projecting that their earnings per share could drop by 28% in 2025. That's a huge decline. So the next 90 days for the market are going to be critical. But all in all, it's important to remember we need to keep a long-term mindset. If you're a long-term investor still in your accumulation phase, don't get too concerned with the day-to-day swings. Just look for the opportunities. Like always, if you'd like to download any of my spreadsheets and also get access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.